Per recent, per recent statistics from Mannheim Market Insights and Cox Automotive, the auto market is currently in the throes of a substantial crash. Car prices saw an unprecedented fall in June, hinting at the conclusion of a 2-year period of considerable hikes. Used cars saw the largest monthly decrease since the height of the pandemic, and new cars are also predicted to rapidly depreciate due to an excess supply issue affecting the U.S. car market. Plus, increased interest rates have made monthly car installments considerably pricier than just a year prior. In addition, numerous Americans who acquired vehicles in recent years are seeing their values plummet, pushing them into negative equity on their loans. This points towards an upcoming wave of financial instability. Today, we're going to break down this situation in detail. However, before we continue, we respectfully ask for your support by liking our video and subscribing to our channel, ensuring you're always in the loop for what's to come. Over the previous 2 years, the cost of purchasing a car has risen drastically by nearly all standards. Vehicle prices have rocketed to record highs, with financing rates escalating sharply. Nevertheless, industry pundits foresee this as potentially just the start of the much-anticipated auto market crash. In June, prices of used cars saw their third successive monthly fall. The wholesale prices for used vehicles dipped by an unprecedented 4.2% from May to June, as indicated by Mannheim Market Insights. Notably, the Mannheim Used Vehicle Value Index, a widely tracked price metric, plunged 10.3% year-on-year in June. Since 2021, used car prices have dealt with significant inflation and supply chain difficulties, causing interruptions in vehicle production and ensuring limited stock. Before the pandemic, the typical price of a used car was a mere $19,827. In May 2023, that number escalated to $26,686, marking a 35% increase, as shown by Cox Automotive data. This 4.2% decrease is one of the greatest in history and the most drastic since the start of the pandemic in April 2020, when the index fell by 11.4%. Chris Frey from Cox Automotive, senior manager of economic and industry insights, conveyed that prices for pickups and vans fell by 6.6% and 8.5% respectively compared to the prior year. Sports cars saw the largest decline, with prices reducing by 14.8% from the previous year. Compact and mid-sized cars also witnessed decreases of over 12% since June 2022. Ray has emphasized that used car stockpiles are expanding swiftly, signaling expected significant price drops in the following months. The Cox report revealed that sales of used vehicles in retail dropped by 4% in June compared to May, and are projected to decrease by 6% compared to the same time frame the previous year. This reduction in demand, in conjunction with an abundance of used cars, points towards this declining pattern being only the start. Projecting forward, the company asserts that the trio of most potent predictors of used car prices, inventories of new vehicles, incentives for new vehicles, and the cost differential between new and used, all point towards a substantial plummet. Analysts at Goldman Sachs have even revised their used car inflation projection downwards by 4% to -11. This implies a potential 14% fall in used car prices from current rates by the third quarter's end, translating to nearly a 25% crash in 6 months. Furthermore, an overabundance crisis in the new car market might further reduce used car prices before the year concludes. Presently, the new car market is experiencing peculiar circumstances. New car prices remain at record highs with robust demand. However, potential buyers are faced with a unique predicament. While some aim to buy a new car, skyrocketing average costs have led many to retain their existing vehicles for a longer duration. This action has created an overflow of new cars that dealers find challenging to sell. Data suggests that hundreds of car dealers are burdened with an oversupply of the new 2023 Jeep Renegades, which could take roughly 2 years to liquidate. Consequently, UBS analysts predict a price competition among dealers as they vie to lower new car prices. The Union Bank of Switzerland has stated that the global car production for 2023 will surpass sales by 6%, leading to an oversupply of 5 million unsold new vehicles. To tackle this glut, substantial price slashes on remaining units are expected in the autumn. Although many automakers are likely to reduce their new car prices later this year, some EV companies like Tesla have already begun slashing their suggested retail prices. In May, the stockpile of new vehicles reached its peak in 2 years, marking a significant rise compared to the month prior. The inventory of unsold new vehicles in the U.S. amounted to 1.96 million units at May's end, indicating a 73% increase from a year earlier. The supply duration escalated to 55 days by the end of May, up 46% from the same period last year. Chungli Chasbora, a senior economist at Cox Automotive, elucidates that declining economic indicators will result in further erosion of demand in the new car market. The surplus will force dealerships and car manufacturers to provide discounts. Nevertheless, despite the potential for eventual relief, the current car market remains the most unaffordable in recent history, says Co-Pilot CEO Pat Ryan. As of the 1st of July, new cars costing under $30,000 comprise only 8% of the market inventory, a stark drop from the pre-pandemic level of 38%, as noted by the car shopping app Co-Pilot. The current average price for new automobiles stands at $47,892, close to a record high, as reported by Edmunds. Simultaneously, cars selling for over $70,000 make up 10% of all sales, an increase from 3% 5 years ago. On the flip side, less expensive options are dwindling, as only 0.3% of new cars sold are priced under $20,000, down from 8% 5 years prior. This price surge pushes more potential buyers out of the new car market. Ryan explains that cost-conscious consumers are opting for used cars with considerable mileage, leading to increased costs of ownership. He adds, "Those least able to afford it are ending up with cars that will cost the most to maintain." In addition, a new high has been reached for new auto loans with monthly payments over $1,000. With the rise in borrowing costs, customers are accruing significant auto debt, risking severe repercussions. Prior to the pandemic, only about 4.3% of buyers financed a new car with such a monthly payment, but that figure has now surged to a record high of 17.1%. The escalating prices of cars and the challenging borrowing conditions present significant obstacles for buyers in today's auto market. Ivan Drury, Edmunds Director of Insights, says that the Federal Reserve's recent halt in interest rate increases has done little to ease consumer concerns. Further, potential rate increases later this year suggest that auto loan rates might continue their upward trend. Car buyers are being charged an average annual percentage rate, APR, of approximately 7.1%, the highest since late 2007. The average loan amount remains above $40,000 for the fifth straight quarter, reaching $40,356. A car industry insider, Car Dealership Guy on Twitter, brings attention to the growing issue of consumer debt. Of every 3 consumers who agreed to a monthly payment of $1,000 or more, the average APR ranged between 8.5 and 9.6%. Around 65% of these individuals had an average loan term of 67 to 84 months. Drury advises that there are good and bad ways to manage a monthly car payment of $1,000. He warns consumers with significant finance charges that they risk entering a negative equity trap. Thus, it's important to make car purchases with a comprehensive budget and a grasp of financing aspects beyond the monthly payment, including the APR. Moreover, recent statistics paint a concerning picture for the auto and finance industries. The average negative equity value of auto trade-ins increased by 29% to $5,341 in the last quarter of 2022, compared to the prior year. Sales involving trade-ins with negative equity also increased by 17% during the same time frame. Such trends could cause a disastrous scenario affecting millions of borrowers and potentially destabilizing financial markets. Negative equity arises when a borrower owes more on a car than it's worth. For instance, a car valued at $12,500 with a $20,000 loan has $7,500 in negative equity, putting the borrower underwater. Holding negative equity is a financial hazard, potentially harming a person's credit score. Auto loans are deemed severely delinquent when payments are overdue by 60 days or more. Data from Cox shows that the first quarter of this year had the highest rate of severe delinquency in auto loans since 2006, with 1.89% of all loans falling into this bracket. The trend is more severe for borrowers with lower credit scores. Among subprime auto loans, 7.3% were severely delinquent, reflecting a surge of over 7% from the prior year and the highest rate since at least 2006. Defaults are also increasing, with the default rate in the first quarter rising 6.2% from the previous quarter and 33.5% from the previous year. As car prices continue to decline, the negative equity trend could worsen. Further expected rate hikes will drive auto loan rates higher, exacerbating the ongoing crisis. Despite optimism from some in the auto and semiconductor industries about resolving supply chain issues this year, the blend of oversupply and reduced demand could lead automakers to cut production of affordable cars. This means borrowers' conditions may worsen before market stabilization. There is considerable potential for further car price reductions, which could trap many Americans in negative equity. We're keen to hear your views on this issue.